Trump tariffs rattle markets, how we're going to navigate Trump 2.0. I'm going to say first, as you know, Warren Buffett called tariffs economic warfare, that I will try to be as little as possible on an editorial about views on particularly the Canada-US situation, and try to give you the clearest roadmap possible for what we do and the playbook and what we're going to do going forward. So let's keep it to the investment thesis, not an editorial. Canaccord has offices in both Canada and the United States, and we'll respect that. So let's go on here. I got to click on that, and then, all right. So where are we year to date? All right, it's markets have been rattled, but ironically, Dow Jones year to date, this was as of yesterday, minus 1.7% on the Dow Jones, which is the 30 blue chip stocks. The S&P 500, roughly the 500 biggest companies, minus 3.9. The last year's winner, NASDAQ, minus 8.6. Canadian stocks, interesting. So trade war, particularly targeting Canada, Mexico, Canada up 0.9. Europe, what a win, 15.1 year to date. Treasury bonds, this is the ETF of long US government bonds, 3.8. Treasury inflation protected securities, 2.8. And again, these don't include any interest. So in the long bonds, you've had about 1% of interest. You've had a little more than that on the Treasury inflation bonds with the inflation adjustments. Canadian preferreds 1.4 with about 1.7 of dividends so far, so well over 3. You do the math in 3 months, 3%. You can do the math there. Magnificent 7, I put this in because these were the, again, not really affected by tariffs on Microsoft. Magnificent 7, again, last year's winners, minus 14.8. Canadian dollar, not a misprint, up this year despite targeted tariffs on Canada. Euro, up 5, and part of that return on Europe is currency up 5 and 10 on the markets. Okay, so let's talk about the topic of the day. And it's interesting, I think this is the highest registrations for my call at 500 registrants, so thank you. So it's certainly on the mind of a lot of people. One of the ways governments deal with trading partners they disagree with is through tariff. A tariff is a tax imposed by one country on the goods and services imported from another country to influence it, raise revenues, or protect competitive advantages. Governments impose tariffs to raise revenue, protect domestic industries, or exert political leverage over one country. Tariffs often result in unwanted side effects, such as higher consumer prices. We're going to dive into that. All right. The following program may contain mature investor subject matter, viewer discretion advised. If you're a new investor, please hold the hand of a mature investor as we go through the playbook. As you know, playbooks are what we do. It got us through the pandemic. We looked at pandemics, and sometimes the results may surprise. The playbook on the surface. This is where viewer discretion. Smoot hauling was the last major tariff increase, which came about in the middle of 1930. Minus 24, following a weak 1929, minus 24, minus 43, minus 8. Ouch. Stocks lost over 70% in cumulative returns over that period. Ouch. Okay, this concludes the call. Thank you for tuning in. Wait a minute. Maybe we should dive a little deeper into these results and see if there's something else that we need to look at. All right, so again, sometimes you get surprised. Tariffs actually in the United States have actually been the norm. The exception is, as you can see, we've got the orange line with the products that had a tariff on them, and the blue line is the total revenue from tariff imports. And, a little bit of history there. Again, we have seen many, many increases, decreases in tariffs. And I'm going to give you a little bit of history. And I'm going to only go back to the turn of the 19th century here, 20th century, I guess, really, in the 1900s. So 1896, Republican election in 1896. The slogan was, "We will renew and emphasize our allegiance to policy of protection." 1896. 1912, the Democrats are in power. They cut tariffs slowly over time from 44 to 25% on average. 1922, Republicans in office. World War I, emergency tariff increases. Okay. Then 1930. Okay, 1930, so we're already high. Smoot haulings, this is what we're talking about. And again, a lot of people, including myself, had believed that the recession of 1929 was made worse with the tariffs, which led to the Great Depression. So we're going to look into that. In May, it passed in June 17th of 1930. The president at the time, Herbert Hoover, May 1930, 1,028 economists signed a petition to ask Hoover to veto the Smoot-Hawley tariff bill. Henry Ford spends an evening at the White House pleading with the government to not pass the bill. J.P. Morgan's president, Thomas Lamont, begs Hoover to veto the bill. The bill passes. Okay? This is, again, history. 1932. The Democrats signed the Reciprocal Tariff Act, which allowed them to negotiate lower tariffs throughout the world. 1947, General Agreement on Tariffs and Trade was signed. The Democrats were in power at that time. 1987, Ronald Reagan, NAFTA, North American Free Trade Agreement, Republican. 1995, the Democrats are in power. The World Trade Organization is formed, which was the new version of the World Trade Organization. And under the Republican of George Bush, China enters the World Trade Organization in 2001. Steady decrease in tariffs over the 200 years of data, but it again, we actually have more than just that one data point. So let's dig a little deeper into tariffs and the playbook for our clients. Okay, 1930 were the tariffs the cause of the recession? Okay, 1930, this is kind of complicated stuff, but the United States was on the gold standard. The Depression was characterized by a deflationary environment, prices falling. Why would they do that? The United States is on the gold standard. Imagine if we were on the gold standard today, the US dollar was backed and linked to the price of gold. Gold is up 40% from 1 year ago. In terms of gold, price of almost anything has declined, whether it's a new car, a house. In terms of gold, everything has declined because gold has gone up faster than things. So you're on the gold standard. And again, in 1930, you've got deflation beginning to hit because you're on the gold standard. And the money supply, the total money supply is a function of two things: the monetary base times the amount of time that each dollar circulates in the economy, called the money multiplier. In 1930, when banks were failing, there was an interesting thing that happened is people actually rushed to the bank and said, "Give me my money." Hoarded money in cash is not multiplied. So money in your wallet does not get lent out. It does not turn in the economy. So as a result, the money supply, not only in the gold standard, but the money supply imploded and went down. And the general consumer price index went down between 1929 and 1937 by 50%. So cash, you were getting wealthier. So of course, if you knew the price of a car was going down and the price of things were going down, you hoarded cash. And of course, that was a problem. 1971, Nixon ended the international convertibility to gold, so the United States no longer tied the US dollar to the price of gold. And of course, it unleashed a torrent of inflation in the 1980s when we went off that gold standard. But inflation and deflation are interesting to follow, and they're kind of close cousins, but investment thesis is the opposite. I've shown you this chart before. This is the money supply going into COVID. Now, the COVID lockdowns could have led to another Great Depression. Economic activity ceased, restaurants closed. 70% of our economy is what we consume on a daily basis. And then we were told we had to stay home. So that would have been incredibly deflationary. Money multiplier was collapsing. As a result, money supply, this is US money supply. This is from the US Federal Reserve, St. Louis Fed, which is one of the branches of the US Federal Reserve, increased the money supply dramatically. So if you look at the trend line of money growth, it went up exponentially, and we almost doubled the money supply during the COVID area for the next few years. They then tried to take that back. If you can remember, US inflation, money supply is the root cause. And I said on one of my calls that the problem would start when COVID was over. Of course, inflation went from basically zero during COVID to 9%, which was highly predictable, is what we said would happen if you follow these sort of basic premises of what the root causes of inflation were. They tried to pull back the money supply, and as you can see, money supply is growing again. So, is there a risk that tariffs would cause a collapse of the money supply? You can only have deflation if you don't print money. Remember that Jerome Powell went on 60 Minutes during COVID because he was so worried about the idea of deflation. He said, well, we're printing money. And they didn't even use code words like quantitative easing. He said, we're printing money, because he was so worried that deflation would be embedded into the economy. So the question is the tariffs, could they create a collapse of the money supply? And that is extremely unlikely, given the fact that we have the tools today in any circumstances to increase the money supply. So here we have, tariffs pushing up prices. This is from CNET. And you look here, some tech providers are already planning for price increases. I want you to picture you're in the car with a 3-year-old or a 4-year-old, and they say, hey, Dad, let's get some ice cream. And then the dad says, what would your mother say? And all of a sudden a light bulb goes off in the 4-year-old and says, I know, let's not tell her. A tariff is a tax, but it's got a different word. And I feel like if you said to the American public, we are going to tax all your televisions and your sportswear and all the things you buy at Amazon that are really, really inexpensive, I think there would be a backlash. But let's be clear. Some tech providers are already planning for price increases. Acer CEO said laptop prices will increase by 10% starting this month because of the import tax. Experts predict also that you'll pay more for Apple devices since many of their products are manufactured in China. In March, this is just last week, the University of Michigan surveys a wide swath of American population to find out the mood, the sentiment. In March 2025, University of Michigan's 5-year inflation expectations for the U.S. rose to 3.9%. So the average consumer expects inflation, which has been low up until COVID, the highest since February of 1993. That's up from 3.5 when we first started. So it's accelerating. One-year inflation expectation has climbed to 4.9%, the steepest since November of 2022. Interesting. Now, let's talk about inflation itself, because are we going to embark on the 1930s deflation, or will this likely increase inflation? One of the instruments of monetary policy is called moral suasion. The two famous are interest rates, money supply, and then there's reserves at banks, and then there's a few things that the bank reserves. One of them is called moral suasion, and that is the US Fed convincing everyone that no, we are committed to 2% inflation. Now, let's remember inflation was running at 2%, and then we had a pandemic supply shock, and inflation went to 8.6 in Canada, 9% in the United States. And the Fed came out and said, well, that was transitory. It doesn't really count. But if you remember, when the price of groceries and the price of stuff went up by 9%, it didn't go back down 7 and then revert to the 2% line. Then they came out and said, we are committed to our long-term 2% inflation objective. There are a number of things that can create inflation. The money supply is the root cause, and then there are the excuses, the transitory things that cause us to lose value in our money losing value against a basket of things. Taxes is one of them. In Canada, we've had a GST. I can tell you, and I'm going to talk about this in a minute, that when the value-added tax, when the consumption tax came in, the builders of those products or the providers of those service just added the tax to their final price. They didn't absorb it as Trump is suggesting. You know, taxes go up and then they say, oh, there's a bump in inflation. Now, yesterday was very interesting because we watched the US Federal Reserve Board, which may under normal circumstances have cut rates. They did not because of the uncertainty of tariffs. But they did say that if tariffs come in and it raises prices, that they would view that as transitory. In other words, a one-time thing. So, you know, are taxes going to create, is this tariff tax that's coming going to create deflation or inflation? Because what we need to figure out is going to be again, close cousins, but we want to do the opposite for our investments. So we'll have to give that a lot of thought. Other things that can create transitory inflation, a spike in oil. Again, if oil goes up, I can just hear the words, well, it's oil, you know, that doesn't matter. But the other things are, we're committed to our global war. There was a lot of excuses about the war in Russia and Ukraine, and that was creating supply shocks. And again, excuses after excuses. But at the end of the day, there is a deliberate policy to devalue our money. This is proof is in the pudding. You know, for our American viewers, and I'm sorry to bias this on some Canadian data, but I think there's a lesson here. In an election gimmick, Justin Trudeau lowered the tax on pop and chips and alcohol. And we have a 5% tax, and in Ontario, they have a harmonized tax, which means that the provincial tax and the federal tax. Now, this is just alcohol and pop and chips. And it was wonderful because when they gave us the tax holiday, inflation went down to 1.9. Well, when they put it back, again, it wasn't, Coca-Cola didn't say, well, you know, there's a new tax that's coming back in. We will not raise our price. Canada, it's a line item, so the price of pop stays the same. It doesn't matter whether it's buried or not. That tax got put back on, and inflation for the month that the tax came back was 1.1% for the month, which puts inflation back to where it was before the tax holiday at 2.6%, and US is running about the same rate. Okay, so one of the things we were hearing last year is American exceptionalism. So that premise was the US is just the best place to invest. You shouldn't invest anywhere else. It's so great. Let's take this with a grain of salt for a moment, and let's also remember that I have been critical of Joe Biden's deficits. I want you to picture a family that after tax makes $100,000, and year one they spend all $100,000, and the GDP of that household is $100,000. Now I want you to picture the next year that mom and dad, neither of them have a raise, and they're still making $100,000 in after tax, and they go out and spend $107,000. Well, the GDP of that household is now 107. Wow, exceptionalism. Joe Biden was running deficits of 7% of GDP. I was critical of when COVID was around, they passed a law called the Inflation Protection Act, which did the opposite of protecting inflation. It accelerated inflation because they decided that like World War II, we need to spend money to avoid the recession of COVID. Well, unfortunately, all of these spending promises hit when COVID was over, and it compounded an inflation problem that we could see with our own two eyes. When I mentioned that Europe was pricing in a whole lot of bad news, and I mentioned this to an advisor that works at another investment firm, which I won't name, but I mentioned we were buying Europe, and he quickly sent me this to read and watch on YouTube. But the death of Europe: high taxes, too many regulations, economic stagnation. People, John Templeton used to say, people are asking the wrong questions, and they're asking where the outlook is the best. And he said, the question I ask is, where is the outlook most miserable? Because exceptionalism gets priced into stocks and you're going to overpay for them. And mired in stagnation gets priced into stocks, and you might be surprised to the upside. That's where you get a bargain. US market was trading at 23 times each dollar of earnings. Europe was trading at 13, pricing in levels in a stock market that had not been seen in decades, and also the greatest deviation of valuation in the history of those two markets for cheap Europe versus expensive United States. Lo and behold, one of the things that's happening is, just picture, I just took a screenshot of the TV here, but one of the things that's happening is, despite the fact that perhaps tariffs will hurt Europe or Canada more than the United States, the exceptionalism of world investors is being questioned with a leader making questionable decisions. And all of a sudden, money has to go somewhere. You've heard this to me a lot of times. Money has to go somewhere. So all of a sudden, most European inflows in a decade probably coming out of the United States, US down, Europe up. Good news is we positioned a good position in Europe away from the United States already. We knew Trump was coming in. We knew tariffs were coming. So what to do in advance of that, not necessarily knee-jerk reactions. I want to point out, is this already happened? Is the trade in Europe over? This is crazy for our American viewers and exchange-traded funds. Just looking at Canada here, and you could do the numbers the same in the United States. We have exchange-traded funds. An exchange-traded fund is a way of buying a basket of stocks like the S&P 500 or Europe. But in Canada, because we live in Canada, we've invented an exchange-traded fund that just buys Apple or just buys NVIDIA, one stock funds. Microsoft, I guess if you're trading at the discount brokerage, they charge a lot of Forex fees, so that's easy for them to buy. You can buy AAPL. That should be AAPL. It's the symbol. NVIDIA is the symbol for the maker of AI chips, and MSFT is Microsoft. So are we there yet? Look, Canada has increased its exposure from Europe from 200 million at the beginning of December to 260 million. Well, part of that is just the rise in the value. But I would say that in just 3 stocks, Canada has 42 times more money than they would like to put in all of Europe. I think that that trade has a long ways to go into Europe, which, by the way, on currency adjusted is still lower than 2007. Okay, let's go on this theme. Money has to go somewhere. Look at Canadian key rates. You could buy a 90-day treasury bill. Okay, no risk, government of Canada, you can get your money anytime. 2.6. Oh, with a 2.6% inflation rate, 2.56 in 2-year bonds, 5-year 2.7 with a inflation rate of 2.6. 30 years, 3.2. We got inflation of 2.6, and that 2.6 is without tariffs. We know inflation's going up with tariffs, unless the money supply collapses and we end up in the Great Depression, which is highly unlikely. So let's look at US rates, 90 days, 4.14. Much better? Not bad. 5-year 4.10, 10-year 4.30, 30-year 4.59. Well, now you're getting interesting. Not bad. We did buy some around the 4 when it hit almost 5% of fixed bonds. Treasury inflation protected securities. Look, in Canada, if you have to buy a bond, you buy the real return bond. You can buy it at about 1.42%. I prefer the US version called Treasury inflation protected securities. Let's call this the magic bond. When you get inflation of 2, you're going to be paid risk-free 4%. If inflation is where it is today at 2.6, you make risk-free 4.6. If there are tariff spikes and inflation does go as expected by this Michigan Sentiment Survey to almost 4.9% this year, you're going to make 6.9%. If inflation in the long run is 3.9%, you'll make 5.9. So the government cannot print away your wealth. The danger in anyone else, look, there is a deliberate, money supply growth is a deliberate, it's deliberately devaluing money so the Great Depression could never happen again. We had a governor of the Bank of Canada named John Crow. Fantastic guy, appointed by Brian Mulroney. He proposed that we have an inflation target, like Switzerland, the only country in the world, of 0. In other words, he said, let's make money not devalue. Let's make sure that it stays at its current rate. Jacques Chrétien fired him. Okay? And again, I'm a fan of Jacques Chrétien and the government that we had at that time, but there is your money. If you say, I'm conservative, I like cash, well, you're in an asset that has deliberate devaluation, and it's highly unlikely, especially in Canada, that you will keep pace with where we're going in cost of living. So let's talk about trade war for a moment. I think you're already starting to see, Delta Airlines 2 weeks ago came out with a profit warning just based on the amount of people that were flying from Toronto to Florida, or, the West Coast versions of the sunny South. So Canadians are actually taking Justin Trudeau's advice and are actually going skiing instead of going to Florida. So interesting. Canadian border crossings to the U.S. drops in February with nearly 500 fewer travelers. Same effect there as what I just showed you. So what's the playbook? Well, let's call it more likely that a tax increase on consumption. I would have preferred that Donald Trump have gone with a value-added tax. The deficit in the United States is way too big. It is unsustainable. So there needs to be some kind of tax measure or massive spending decreases. And even though they're trying to take a hammer to with Doge and Elon Musk, it's likely still going to be very difficult. So in Canada, what we did is we brought in the GST, goods and services tax, which applied on all products. The United States has decided to go with just imports. So look, people are looking at the headlines and they are seeing the negative headlines. Sentiment survey, I've quoted this many, many times to give us a clue. And you can see here that in January, we were, 43% bulls, December the 4th, 40, 48, 30. Those are normal readings, 49 in November, bulls, bears. We tend to get about 40 on average, bullishness and 30% bearishness. When you see numbers of 19 and 60, bulls versus bears, this has only happened since 1987, 6 times, and every one of those have been buying opportunities. We saw those kind of numbers at the pandemic bottom. We saw these in the 09 crisis. We saw these after the 1987 stock market crash. By definition, if people are bearish, they've probably sold because they think stocks are going lower. So by definition, we want to buy when there's a lot of bearishness, meaning negative on stocks, and we want to sell when the bearishness evaporates. Sometimes I did a letter many years ago telling where are the bears, and this was in the 08 peak of the market, and people were so bullish that I talk about water level in a swimming pool. If everyone's in the pool, then the water level can't go up much. Okay. I am not feeling the panic that I felt from my clients. They're worried. What do we do? Some people called in and they're really worried. And I say, have you looked at your account? And they go, no. Well, I read, they're looking at the headlines. I go, well, you're up. Not only were you up exceptionally last year, you're up this year. Oh, okay. I think the number one traded stock in the United States on the do-it-yourselfers is Tesla. It's the biggest owned stock. So there's Tesla pre-US election going from $250 to almost $500, $490, and collapsing all the way back to, hey, we got a guy in the White House who's buddies with Elon Musk who makes Teslas, and now actually people are associating Donald Trump with Elon Musk and they're boycotting Teslas. European sales have plunged. I'm sure Canadian sales are going to do poorly. So maybe a poster child, maybe our clients are sealing, this is a survey of individual investors. The individual investors are heavily invested in the Magnificent Seven stocks. They're not invested in Europe, otherwise they wouldn't be so negative. They're not invested in bonds as we are. So it might be skewed by this, but when you get clusters of bearishness like that, it gives you a buy signal. I'm just going to go back here and just talk about the playbook, because again, the warning I had with the experience of 1930. Paul Krugman, this is a famous economist, okay, New York University. Since a decrease in imports is expansionary, a trade war in which global exports and imports will decrease equally, a trade war does not create a recession. Smoot-Hollings was entirely the consequence of the Depression, not the cause. This is Paul Krugman. Milton Friedman, perhaps one of 2 famous economists in the world, John Maynard Keynes and Milton Friedman. Maybe Adam Smith up there, but he wasn't alive long enough to have the Great Depression. Smoot-Hawley tariff of 1930 did not cause the Great Depression. Peter Temin points out exports were 7% of GDP in 1929. They fell 1.5% in each of the next 2 years. Global GDP fell 15. If exports went to 0, The numbers were way beyond the delta of trade, okay? US GDP fell 26%. Exports were down on a relative to GDP by 3. It can't be the cause. So most probable is that right now we are playing the inflationary aspect of a tariff or a consumption tax. Let's call it what it is, a consumption tax. I'm stating a fact when I say, based on experience in Canada, a consumption tax will not be paid entirely by the manufacturers, whether it's Canadians or Chinese. I don't, for the life of me, I'm not a fan of tariffs. I think it's a terrible, I remember around 1980, I think, my dad came home with a Sony massive 20-inch Trinitron television. It was $649. I remember going out to buy it. We were so excited. $649, you can go to Costco and get a massive, 60-inch TV for $640. Beautiful TV for $649. Why we would want to stop that? Let's call it what it is. It is just a consumption tax, which the government is hoping to bring in revenues from. These magic taxes will not just magically bring in revenues without consequence. The playbook. I'm hammering a horse here. These are preferred shares that we have bought. We've owned for clients, many of these. And we said, even though we bought them at 15, most of these over time will eventually be called in at $25, just since the beginning of the year, well, December 31st. Cenovus, Fairfax, CIBC, TD, National. Cenovus again, March 31st. Fairfax again, Fairfax called in 2 issues. Cenovus, every quarter they've been calling. There's another one next quarter. So many of our clients that bought them at 50 cents, 60, 70 cents on the dollar are getting 100 cents, and they've collected fabulous dividends. I mean, these are well into double-digit returns for our clients since we bought them. These are preferred shares that did not get called, and yet they reset just in the recent past. Again, because when they reset during COVID, rates were 0, and they pay an interest rate spread. So let's say Enbridge, which pays 2.64 above the rate, rates were almost 0 the last time, so the dividend got cut. Well, the dividend had to almost double because rates were about 3% when that Enbridge reset. So for the next 5 years, you could buy a GIC at 3% guaranteed, at a bank, or you could buy Enbridge with a 7, more than double a GIC rate. TC, which is TransCanada, Bell Canada, Pembina Pipelines, Brookfield, which was, by the way, our current prime minister was the chairman of Brookfield. Tax equivalent yield, look at that. You're making 7. And if for GICs, because we get a dividend tax break, and these are on the highest, these taxes are on the highest tax rate. I have a friend who made roughly $200,000. He's a client, made roughly $200,000 of mostly Canadian dividends. Split, wife, himself, 200 grand. They paid less than $10,000 in taxes. Why? At the lower income levels, the tax credit is even more valuable. So for many people, you will pay no tax on Canadian dividends. Unbelievable. You'd have to get 10%. You could own Bell Canada preferred, or you could own a GIC at 10. It'd be the same. So why someone would buy a GIC at 3 with inflation staring us in the face is amazing. Okay, let's talk about a few other things, and I'll wrap it up. Canadian election, sorry for a long call. Canadian election coming. Canadian dollar, housing. Mark Carney, this is today's Globe and Mail. Mark Carney expected to call a snap election. So we're expected to call it Monday for April 28th. Look, I've not been a fan of the current government. Real GDP per capita in Canada has been almost the worst in the world, led by Ireland. Low taxes. This is growth. This is how your economy has grown over the rate of inflation on a per capita basis. Canada is behind Mexico. It's incredible. This government has focused far too much, in my opinion, on wealth redistribution and not enough on growth. When Germany came begging to, when their natural gas supplies were going to be, which came from Russia, they said, Canada, can we do a deal? Justin Trudeau said, I just can't see a business case. I will say that Mark Carney on his campaign has been campaigning as a conservative. He wants to, even though he was a champion of the carbon tax, he says he wants to replace it. I'd be cautious. I think it'll be replaced with something that looks almost the same. He wants to lower taxes. He wants to increase. He wants to provincial trade. He wants to build pipelines. So in a sense, it's poor our conservative leader, Pierre Poilievre, he's taking the entire playbook away from Pierre. So I feel global investors that Canada has a conservative against a conservative. The polls have completely flipped. The polls have gone from the conservatives up by 20 points, which was one of the greatest spreads in history, to the liberals under Mark Carney up by a couple of points. I will point to the betting sites. Where is the money going? You know, when Kamala went in the United States above Trump after the inauguration of Kamala, she was 3 or 4 points up on the polls, but the money, the betting sites stayed with Trump the entire time, and they were right. The betting sites right now, you can go to them, Odds Shark, and the betting sites are 60% in favor of the conservatives. We shall see. It'll be a very interesting time. Let's talk about the Canadian dollar. You would think it would have collapsed. It's very difficult to make your investment thesis on tariffs, which you don't know exactly what they are. It looks like oil's off the table, and it looks like the auto parts are off the table. So at the end of the day, the Canadian dollar. Why in the world would anyone buy it? Well, let's talk about the U.S. situation. Exceptionalism, maybe not so much. We just went through that. Number two, government debt, federal debt relative to GDP, the total size of the U.S. economy is at 100%. In Canada, it's 40. I mean, the one thing I'll give Justin, and I think he's way overtaxed, but even though they increased the size of the government way beyond what it should have, they actually ran a deficit. I'm not in favor of deficits, but they ran a deficit, and the debt is still only 40. This compares to U.S. debt of 100. So that's one reason the Canadian dollar isn't collapsed. Number two is on a purchasing power parity, it's actually about 10% undervalued relative to the United States. So, if there's a deal, watch out. I've got clients, should I be 100% US dollar? Be careful, because if there's a deal, the Canadian dollar goes up. So I think the free lunch here is you need to own both. Canada, US, Americans should have not all their money in the US dollar. Canadians should not have all their money in Canada, but they shouldn't have it all in the United States too. There's no way you can get a bargain like that on preferreds. Most US preferreds are trading already at their par value, $24 to $25, yielding only 5%. We're still buying preferreds at 70, 75 cents on the dollar, and we're buying them at 7% dividends. So let's be careful. If we can get a great return in Canada, we will compensate investors for any decline. Canadian dollar declined last year, and yet we had higher returns on our Canadian side than our US side. So just be careful of abandoning where we're getting bargains in terms of the investment side. Let's talk about housing for a moment, and I'll be done. I think this is creating an even bigger, I've talked to, for our new callers, I believe that housing is in trouble in Canada. COVID was 5 years ago. We have a mortgage cliff coming. US had a mortgage cliff in 2008 and 9 as mortgages were teaser rate mortgages, subprime mortgages were going to renew. Canada, we dropped our mortgage rates. Americans can't believe this. We had mortgage rates of 1.5% in the COVID year and almost as low the year later. And people went out and borrowed like crazy. Honey, we can afford that house. Those mortgages are coming due at 4 to 4.5% mortgages. And they started when we unlocked and you allowed to go out. So they start this summer and they're going to go like crazy for the 18 months starting this summer. That rollover cliff is going to be a problem. Now what you've got is the tariff uncertainty. And look, real estate transactions have plummeted, and it's only a matter of time before prices. We're starting to see it in new condos, which the developers just can't sell, and they're starting to really slash prices. And that's the beginning of the price declines, and then you're going to have a problem. So please avoid mortgage investment corps, real estate exposure. I've talked about a Vancouver house that has huge exposure of a financial planning firm to Canadian real estate. Please avoid that kind of stuff. I would say that there are bargains all over the place in stocks. The Magnificent Seven, the bloom is off those, and then people are looking where else they can go. Highly probable that the result of tariffs will be inflation, not deflation. I think the greatest risk to the market is, as Trump is very unclear, we have to watch for April 2nd because retaliatory tariffs are coming against Europe. What does this mean? But it's the uncertainty that is creating a potential pause in capital spending. I have a friend who is in the United States. He builds data centers, massive structures. These are predominantly steel reinforced structures. They don't know what the price of steel is. Everything's on hold. Even the Caterpillar generators is very difficult to price. So if with that much uncertainty, there's a tendency to say, let's wait till we know what the tariff situation is and what the price is. So I worry that this is creating a bad policy. I think tariffs are a terrible policy. I think it's a sad time in history. Does it mean we should be in a devaluing cash? It does not. Okay, so that's all I've got to say. I would say stay the course. I'm excited about a lot of things that we can invest in without risk. Again, it's been almost 20 years since we've been able to buy treasury bonds. Everyone should own the magic bond, the treasury. Inflation, no matter how much they print, no matter how much they tax, they have to pay us. The only place in the world that only type of investment that we have that luxury, and we own them because we couldn't own them before, because when inflation spiked, these bonds were trading at one point with a -3 real yield, but now we can buy them at a +2. So I love it. Thanks for tuning in. Again, I think it's the highest number of people that called in live. We will send out the replay hopefully shortly, and thanks for tuning in. Thanks, everyone.